Hello, everyone, and a really warm welcome to all of you tuning in today. Thank you so much for pressing play. We really appreciate you spending some time with us.
It's great to be here, and honestly, today's a big one. There's a lot to unpack.
There absolutely is. It is Tuesday, January 20th, 2026. Netflix just wrapped their Q4 earnings call, and if you just read the headlines, you see these massive numbers. But if you actually dig into the transcript, which we did, it feels like the whole philosophy of the company is changing.
Oh, it really does. For a decade, the narrative was the streaming wars, right? But reading this, it's like Netflix has declared victory there and is now fighting a completely different battle. They seem to be moving from just being a utility you subscribe to, I don't know, a lifestyle ecosystem you live inside of.
That is a big, big claim. But before we get to the really contentious stuff, and I'm talking about that massive acquisition, we should probably look at the scoreboard. They started with their prepared remarks. So how did the company actually do in 2025?
Okay, so the short answer is they're flush with cash. They have a very full war chest. They closed out 2025 with 16% revenue growth.
16%. Wow.
But the number that really turned heads on the street was operating profit. That grew around 30%, which, by the way, beat their own internal targets.
And I'm guessing the ad-supported tier is doing a lot of the heavy lifting there.
A huge amount. Ad sales grew 2.5 times in 2025.
2.5 times.
Yeah, I mean, that's just exponential growth.
So they have the cash. What about the forecast? What are they telling Wall Street to expect for 2026?
They're projecting $51 billion in revenue. That's up 14% year over year. And they're targeting an operating margin of 31.5%, which is a 2-point jump. And get this, they expect ad revenue to double again to about $3 billion.
$51 billion. That is just a staggering amount of money for a company that sells subscriptions and ads. But of course, you need the content to keep people paying.
Yeah.
So what's the plan for shows this year?
This was interesting because they sort of admitted a mistake from last year. 2025 was very back-weighted, a drought of content early on, then a flood at the end. For 2026, the key word is smoothness. They want a steady drumbeat of hits.
To prevent churn, right. Stop people from canceling in the quiet months.
Exactly. Churn is the enemy. They pointed to the Stranger Things finale, which is still dominating. Then you have Bridgerton Season 4, One Piece Season 2, The Night Agent Season 3, and Beef Season 2 all coming.
Okay, a lot of sequels. What about films?
Big names. Leaning into big names.
Right.
The Rip with Matt Damon and Ben Affleck, a Peaky Blinders film, and Greta Gerwig's Narnia. Plus, they made a point to mention they're expanding into live events like the World Baseball Classic in Japan and pushing into video podcasts and cloud gaming.
And of course, the elephant in the room, they dropped the big one right at the start. They're working hard to close the acquisition of Warner Bros. Studios and HBO. They called it a strategic accelerant.
Which is very specific corporate speak for pouring gasoline on the fire.
Well, let's see if the analysts bought that explanation. That brings us to the Q&A session. And I have to say, the tone here was... It wasn't just congratulatory. There was some real skepticism.
A lot of skepticism, yeah.
Okay.
Let's get into it.
First question was from Robert Fishman of MoffettNathanson. He brought up that Wall Street Journal report about an internal memo. Something about Netflix wanting to double revenue and triple profits. He basically asked, have you reevaluated how fast you can grow, and did those targets already assume you'd buy Warner Bros.?
Right. This was the organic versus bought growth question. And Greg Peters, the co-CEO, he had to be very firm here. He clarified that those internal goals were based purely on their organic progress. No M&A factored in.
So he's saying they could hit those massive numbers even without owning HBO.
That's the claim, yeah. He said they're forecasting healthy organic growth and still feel good about those long-term targets, and he brought out their favorite stat to back it up.
Let me guess. The under 10% of TV timeline.
You got it. He said the market opportunity is still massive since they're under 10% of TV time in major markets.
The classic, we're not a monopoly, we're just getting started defense. Okay, next up, John Blackledge from TD Cowen wanted to dig into the math. He asked about the drivers for that 2026 revenue guidance, which was higher than consensus, and that 31.5% margin.
Spencer Wang and Greg Peters took this one. For revenue, it's pretty straightforward. More members, some pricing changes, and that ad revenue doubling to $3 billion. But the margin answer, that had a really interesting little detail. They're guiding to 31.5%, but that number actually includes a 0.5% drag from expenses related to the Warner Bros. Deal.
Wait, so if they weren't buying a studio, their profit margins would be even higher?
Exactly. Without those transaction costs, then the margin expansion would be 2.5%. They also said they're purposely increasing some expenses to invest in new licensing deals with, Sony and Universal, and to upgrade their ad tech.
Okay, so spending money to make money. Makes sense. Now, this next question is where I think the whole philosophy of the company gets tested. Rich Greenfield from Lightshed, he always asks the tough ones. He asked about engagement. He noted that the company is now saying not all hours of engagement are the same. And this is a crucial pivot. For years, Netflix worshipped hours viewed. If you watched, it was good. But Greg Peters and Ted Sarandos are kind of changing the metric now. They admitted that while total view hours grew 2% in the second half of 2025, that doesn't really tell the whole story.
2% growth sounds pretty flat for a company forecasting huge revenue jumps.
It does, but here's the nuance they offered. Branded originals grew 9%, but licensed titles dropped because of volume shifts from the strikes. So their argument now is quality over quantity. They believe a superfan who watches every episode of Stranger Things is way more valuable than someone who just has a sitcom on in the background.
So 10 hours of active fandom is worth more than 50 hours of passive background noise. That's exactly it. They claim their retention is among the best in the industry because of this, even if raw hours aren't exploding.
It's a convenient story, but let's run with it. Next up, Ben Swinburne from Morgan Stanley circled back to the acquisition. And he asked the question I think a lot of people are thinking. Does buying Warner Bros. Mean your organic engagement is stagnant and you need their IP to fix it? Basically, is this a rescue mission?
Greg Peters pushed back hard on that stagnant idea. He used Japan as an example. He said Japanese consumers watch, on average, about half as much TV as Americans. So as Netflix grows in Japan, it actually drags the global average hours down, even though the business there is booming. So he reframed Warner Bros., not as a fix, but as that word again.
An accelerant?
An accelerant to a strategy that's already working. He said WB brings a century of IP and the prestige of HBO, which just complements what they do.
Okay, and following that, Mike Morris from Guggenheim had a very practical question. Is this deal going to make my subscription price go up soon?
Yeah, a good question. And Greg Peters was very direct. He said, no impact or change to the approach. So they're sticking to their current pricing plan, regardless of the deal.
Rich Greenfield came back for another round. He pointed out that, Greg Peters has sounded pretty skeptical about M&A in the past, so he asked, what surprised you during the Warner Bros. Due diligence that changed your mind?
This was a great question. It gave us a little peek behind the curtain. Spence Newman, the CFO, jumped in and clarified that they used to debate building their own theatrical business, but they always prioritized other things. With Warner Bros., they saw a mature, well-run theatrical and TV studio just ready to go.
And what did Peters add?
He was all about HBO. He called it a prestige brand that people love. Yeah. He thinks having HBO will let them structure their subscription plans better. But he made a key point. Even after the deal, on a pro forma basis, 85% of their revenue will still come from the core streaming business. It's an accelerator, not a pivot.
Okay, so speaking of the deal itself, Rich Greenfield asked the third question. Why are you so confident this will get regulatory approval? The DOJ has not been friendly to big tech mergers.
Ted Sarandos took this one. He said they've submitted their filings and are arguing the deal is pro-consumer, pro-worker, and pro-creator. But his real argument was about the competitive landscape. He basically said, look around. He pointed to YouTube now surpassing the BBC in the UK in viewership. He pointed to Amazon owning MGM, Apple's huge content spend.
He specifically called out YouTube.
Oh, yeah. He said YouTube is now TV. They show the NFL. They show the Oscars. His whole point is that Netflix isn't some monopoly. They're trying to compete in a market against trillion-dollar tech giants. It's a pretty compelling we're the underdog argument, even from the biggest streamer.
That's a smart legal strategy. Don't look at us, look at Google. Okay, shifting gears to content. Vikram Kesavapotla from Baird asked about the recent live events like the Jake Paul fight or the NFL games on Christmas.
And Ted Sarandos admitted that live is still a really small slice of total viewing. But again, it's about impact, not volume. Live events drive conversation, buzz, new signups. He also said they're expanding that globally with the World Baseball Classic in Japan.
Vikram also asked about podcasts. They're adding video podcasts.
Right.
What kind are actually going to work on Netflix?
Ted described them as modern talk shows. Yeah. And this goes back to that ecosystem idea. They don't want just one hit. They want a broad offering. He mentioned sports, comedy, true crime. They've already launched shows from Spotify, The Ringer, and Barstool. It's all about keeping you in the Netflix app, even when you're not in the mood for a 2-hour movie.
It really is. It feels like they're trying to solve that what do I do now problem. And Rich Greenfield, man, he really dominated this call, jumped in again about the theatrical window. Netflix used to be famous for releasing movies on the service day and date. Now they're buying a movie studio, he asked. Why the change of heart?
Ted Sarandos had a great line here. He said, "Business, not a religion." He explained that before they just didn't have a theatrical distribution engine. It didn't make sense. But buying WB gives them a $4 billion theatrical business. He confirmed they will maintain the traditional 45-day theatrical window for Warner Bros. Films.
That is a massive reversal. They're finally admitting some movies make more money in theaters first.
It's pure pragmatism. They're just chasing the revenue wherever it is.
And speaking of revenue, Steve Cahill from Wells Fargo asked about the ad tier. He asked if they can reach parity on ARM average revenue per membership between the ad and ad-free plans in 2026. Basically, is an ad tier subscriber going to be worth as much as a premium one?
Greg Peters said there's still a gap, but it's narrowing. He said the big focus right now is on monetization, specifically on fill rates.
Can you quickly explain what a fill rate is?
Sure. It's just the ratio of ad slots they have available versus the ad slots they actually sell. Right now, Netflix has so many viewers on the ad tier, they don't always have a paid commercial to show. That's wasted inventory. So the goal is to double ad revenue by just improving that fill rate while keeping their ad prices, their CPMs, at a premium.
So they have the eyeballs, they just need to sell all the slots.
Exactly right.
Okay, Vikram from Baird came back with a question about video games. Are they actually working? What's the plan for 2026?
Greg pointed to successes on mobile, like Red Dead Redemption and GTA. But the big priority for 2026 is cloud-based TV games, so you can play on your TV without a console. They've reached about 10% of eligible members so far. They're launching casual games like Boggle and Pictionary, but also a new FIFA football simulation game.
Wow, FIFA and Boggle are very different audiences.
They are, but that's the point. They want to tap into the $140 billion gaming market. If you're playing Bobble on your TV through Netflix, you aren't scrolling TikTok or watching YouTube. It's all about capturing your attention.
And finally, Rich Greenfield closed it out. He asked why vertical video, the TikTok format, isn't a higher priority.
Greg said they have actually been testing a vertical feed of clips and podcasts for about 6 months. But he framed it as just one part of a much broader mobile UI upgrade that's coming later in 2026. So the TikTokification of Netflix is coming, just maybe not tomorrow.
What a marathon of a Q&A session. Okay, let's zoom out. If we look at the big picture, what are the main themes we should be walking away with?
I think there are 4 big ones. First, just financial health. They had a strong 2025. They're forecasting $51 billion for 2026. The core engine is working, fueled by organic growth and that booming $3 billion ad business.
Okay, number 2.
The Warner Bros. Acquisition. That's the dominant story. Management is working overtime to frame this as an accelerant, not a desperate pivot. And they seem pretty confident they can beat the regulators by pointing at YouTube and Amazon.
And the third theme?
Content diversification. It's moving way beyond just movies and TV. Live events, video podcasts, cloud gaming. They are building a walled garden of entertainment to keep you inside.
And last,
the shift in metrics. We're moving away from raw view hours to this idea of quality engagement and fandom. They don't just want your time anymore, they want your loyalty.
It really leaves us with a provocative thought to chew on, doesn't it? For years, we thought of Netflix as the cord cutter's dream, the alternative to cable. But when you look at all this, live sports, newsy podcasts, bundles with HBO, theatrical releases, are they still the alternative? Or have they just become the new, better digital cable bundle we were all trying to escape in the first place?
That is the question for 2026.
Well, thank you so much for breaking all of that down. That was a dense one, but so important.
My pleasure.
And a huge thank you to all of you for watching and listening. If you found this breakdown helpful, please do click like, share the video, and subscribe to the channel. We'll be tracking this acquisition very closely, so stay tuned for more. We'll see you next time.